What if I told you that the silver crash you saw on the chart wasn't panic, wasn't bad luck, and definitely wasn't coincidence? What if that violent drop, the one that wiped out accounts in minutes, was actually designed by the mechanics of the system itself? Think about this for a second. Millions of traders watching the same level, the same breakout, the same bullish narrative, inflation fears, money printing, hard assets rising. Silver was obviously going up until it didn't. Instead, it collapsed, fast, brutal, surgical, right at the moment when leveraged positions could no longer breathe. Ray Dalio once said something most people ignored. Markets don't move because of opinions. They move because of forced actions. And that single idea changes how you see everything. In this video, you're going to understand why silver crashed at the exact moment of the margin call, why it wasn't random, and why this same pattern repeats again and again across markets, stocks, crypto, commodities, everything. More importantly, you'll learn how to protect yourself from being on the wrong side of it. This matters right now because leverage is higher than ever. Retail traders are borrowing money without realizing it. Institutions are watching positioning, not headlines. And every cycle, the same people get liquidated. Not because they're stupid, but because they're playing a game without knowing the rules. If you've ever asked yourself, how did the market drop so fast? If you've ever been stopped out right before price reversed, if you've ever felt like the market was hunting you personally, this video will feel uncomfortable, but it will also set you free. Because once you understand this mechanism, you stop blaming the market, you stop chasing news, and you start seeing price as a reflection of stress, leverage, and forced selling. This isn't about predicting the future, it's about understanding the machine. And once you see it, you can't unsee it. Let's start with the uncomfortable truth most people avoid. Here's the hard reality. Most people don't lose money because they're wrong about direction. They lose money because they're overexposed. You've seen it in real life. A trader buys silver futures or leveraged ETFs. The thesis makes sense. Inflation is rising. The dollar is weakening. Central banks are printing. Everything screams silver up. So they don't just buy, they borrow, margin, leverage. Just a little, they tell themselves. At first it works. Price moves up. Confidence grows, positions get bigger, stops get wider, and then a small pullback happens. Nothing dramatic, but suddenly accounts start flashing warnings. Margin utilization spikes. Brokers start calling. This is where most people misunderstand what's happening. They think the market is turning bearish. No, the market is testing stress levels. When enough participants are leveraged in the same direction, the system becomes fragile. It doesn't take bad news. It doesn't take a crash. It only takes price to move far enough to trigger forced selling. And forced selling doesn't care about logic. It doesn't care about fundamentals. It doesn't care that silver is undervalued or that inflation is high. A margin call means one thing: sell now or we sell for you. That's why the drop feels unnatural. That's why it's fast. That's why it slices through support levels like they don't exist. It's not discretionary selling, it's mechanical liquidation. The painful part, most retail traders don't even realize they're participating in this cycle. They think leverage is a tool for professionals. They think institutions control everything, but institutions use leverage. They don't worship it. Ignoring this reality has consequences. Accounts blow up, confidence disappears, people quit investing altogether, believing the market is rigged. But the truth is more subtle and more empowering. The market isn't evil, it's indifferent. And if you don't understand how margin, leverage, and forced selling interact, you'll keep being surprised by events that were actually inevitable. Which brings us to the core idea Ray Dalio keeps pointing to, the real engine behind crashes like silver. Let's break this down simply. A margin call happens when you borrow money to invest and the value of your position drops below a required level. When that happens, your broker demands more capital immediately. If you can't add funds, your position is liquidated automatically. Now, here's the key insight Ray Dalio emphasizes. Markets move when people are forced to act, not when they change their minds. Imagine 10 people calmly deciding whether to sell. That's slow, thoughtful price movement. Now imagine 10,000 people being forced to sell at the same time. That's a crash. Silver didn't fall because everyone suddenly hated silver. It fell because too many people were on the same side of the trade using borrowed money. Think of leverage like stacking bricks on a table. One or two bricks are fine. 10 bricks make the table unstable. A small shake, not an earthquake, and everything collapses. The market shake is often tiny. A stronger dollar for a day, a bond yield tick up, a liquidity shift. On its own, meaningless. But when leverage is high, it becomes the spark. This is why crashes often happen at obvious levels. Support zones, trend lines, psychological prices, that's where stops sit. That's where margin pressure concentrates. Once the first layer sells, price drops. That drop triggers the next layer, then the next. A cascade, not conspiracy, physics. Dalio explains this as a deleveraging cycle. Debt expands, asset prices rise, leverage builds. Then something breaks the balance. Forced selling begins. Prices fall faster than people expect because selling isn't optional anymore. This is why charts look clean after the crash, because all the weak hands are gone. Understanding this changes how you interpret price action. Instead of asking, is silver bullish or bearish? You start asking, oh, how leveraged is this market? And that question is far more powerful. Now let's go deeper and look at how this plays out in real scenarios. Picture this scenario. Silver rallies for weeks. Headlines turn bullish. YouTube thumbnails scream, 50 silver incoming. Open interest rises. Leverage increases quietly in the background. Most people don't track this, but institutions do. Now price stalls. Just a little. No crash yet. This is where professionals pay attention, not to news, to positioning. If too many traders are long and leveraged, price doesn't need bad news to fall. It only needs lack of new buyers. Gravity does the rest. The first drop shakes out overconfident traders. Margin utilization jumps. Some positions are closed. Price dips further. Now algorithms detect liquidation zones. Volatility increases. Liquidity thins. This is where the real damage happens. Stops get hit in clusters. Forced selling accelerates. Price overshoots fair value. Not because silver is suddenly worthless, but because sellers are desperate. Ray Dalio calls this mechanical pressure. It's not emotional, it's structural. Here's the insight most people miss. The best buying opportunities often appear right after forced selling ends. Not during the panic, but after leverage is flushed. Institutions wait for this. They don't fight liquidation. They let it finish. This pattern isn't unique to silver. It happened in 2008, in March 2020, in crypto cycles. Every time leverage builds too high, the unwind is violent. The practical takeaway? Don't measure risk by how confident you feel. Measure it by how much leverage exists in the system, including your own. Because price doesn't fall until it has to. And when it has to, it doesn't ask permission. Which brings us to the myths that keep people trapped in this cycle. Myth number 1, the market is manipulated. Reality, the market is mechanical. Leverage creates fragility. Fragility creates crashes. Myth number 2, strong fundamentals protect me. Fundamentals don't stop margin calls. Cash flow doesn't stop forced liquidation. Liquidity does. Myth number 3, I'll just use a little leverage. Leverage doesn't hurt when things go right. It destroys when they go slightly wrong. One of the biggest mistakes traders make is confusing volatility with risk. Volatility is visible. Risk hides in leverage. Another mistake is emotional attachment. People fall in love with assets. Silver becomes a belief, not a position. And beliefs don't survive margin calls. Ray Dalio warns against this mindset repeatedly. Don't confuse what should happen with what must happen. What must happen is driven by balance sheets, not opinions. When you stop seeing crashes as betrayals and start seeing them as balance sheet events, your entire approach changes. Now, let's turn this understanding into action. Here's a simple, realistic plan you can actually follow. Step 1, respect leverage. If you don't fully understand how margin works, don't use it. Cash positions survive volatility. Leverage ones often don't. Step 2, size positions assuming the worst, not the best. Ask yourself, if price drops 20% tomorrow, do I survive? If not, you're overexposed. Step 3, watch sentiment, not headlines. When everyone agrees, risk is highest. Step 4, keep dry powder. Cash isn't cowardice, it's optionality. Step 5, wait for forced selling to end before acting. Don't catch falling knives. Let liquidation finish. Step 6, think in cycles, not predictions. Deleveraging always follows leverage. This isn't about being bearish or bullish, it's about staying solvent. Because you don't need to be right all the time. You just need to avoid being forced out. If this perspective helped you see the market differently, take a second and support the channel. A like tells the algorithm this kind of deep, honest finance content matters. A share helps someone else avoid a painful lesson. And subscribing means you won't miss future breakdowns like this. This channel isn't about hype. It's about understanding the system so you stop fighting it. I don't promise shortcuts. I don't promise easy money. What I promise is clarity, and clarity is rare. Your support allows more research, better breakdowns, and deeper insights into how markets actually work behind the scenes. Now let's close this properly. Silver didn't crash because it failed. It crashed because too many people borrowed confidence. Ray Dalio's lesson is simple but uncomfortable. Markets punish fragility, not ignorance, and leverage is fragility disguised as opportunity. The real edge isn't prediction, it's survival. When you understand margin calls, forced selling, and deleveraging, crashes stop feeling random. They feel inevitable and manageable. Remember this: price doesn't move to surprise you, it moves to relieve pressure. And if you're not pressured, you're not forced. Stay patient, stay liquid, stay humble, because in markets, the ones who last win.